A surplus reinsurance treaty is a type of proportional reinsurance where the insurer retains risk up to a specified limit, known as the retention, and cedes the excess or surplus above this retention to the reinsurer. It allows insurers to keep smaller risks while transferring portions of larger risks to a reinsurer. Key features of a surplus reinsurance treaty. Retention: the insurer retains a specific amount of risk, called the retention, and cedes any risk above that amount to the reinsurer. For example, if the retention is $2 million, the insurer keeps the first $2 million of risk and cedes any surplus above that. Lines of cover: the reinsurer covers risk in lines, which are multiples of the insurer's retention. If the insurer has a $2 million retention and the treaty allows for 3 lines, the reinsurer covers up to $6 million of surplus risk, so the policy would have $8 million total coverage. Proportional sharing above retention: for the portion above the retention, the reinsurer receives a proportional share of the premiums and pays the same percentage of any claims. Flexible risk cession: unlike a quota share treaty, which applies to all policies, a surplus treaty allows the insurer to fully retain smaller risks and cede only the surplus of larger risks. Example of a surplus reinsurance treaty. If the insurer has a retention of $2 million and cedes a policy with $6 million in coverage, the insurer retains $2 million. The reinsurer covers the remaining $4 million. For a $3 million claim, the insurer pays $1 million and the reinsurer pays $2 million. Benefits of a surplus reinsurance treaty. Retention control: the insurer controls how much risk to retain, only ceding larger risks to the reinsurer. Flexibility: the insurer retains smaller, more predictable risks, while sharing larger, more volatile risks, optimizing their portfolio. Increased capacity: surplus treaties allow insurers to underwrite larger policies than they could otherwise handle. Capital efficiency: by ceding excess risk, insurers reduce the amount of capital they need to hold in reserve, improving capital management. Earnings stabilization: sharing large risks with the reinsurer helps the insurer maintain stable financial results by protecting against major claims. Drawbacks of a surplus reinsurance treaty. Complex administration: the insurer must calculate how much risk to cede on each policy, making administration more complex. Reduced premium share on large risks: the reinsurer takes a proportionate share of the premiums for larger risks, reducing the insurer's potential profit. Profit sharing: the reinsurer shares in the underwriting profit from larger policies, meaning the insurer doesn't retain the full premium on profitable large risks. Ceding commissions: insurers negotiate ceding commissions to cover their costs, but if the commission is too low, profitability could be impacted. Use cases for a surplus reinsurance treaty. Large risks: surplus reinsurance is ideal for large commercial risks, such as property, marine, or aviation, where the policy values exceed the insurer's retention. Variable portfolios: insurers with a wide range of policy sizes benefit from retaining smaller risks and ceding larger ones. Earnings stability: for insurers with volatile portfolios, surplus treaties help manage large, unpredictable risks, providing financial stability. Conclusion: a surplus reinsurance treaty offers insurers flexibility to retain smaller risks while ceding portions of larger risks to a reinsurer. This enables insurers to expand their underwriting capacity, manage capital efficiently, and protect themselves from large losses. It is particularly useful for insurers with a mix of small and large policies. However, careful management of retention and ceding commissions is necessary to ensure that the treaty is beneficial.